Japan is the world's largest holder of national debt. Here's data from the International Monetary Fund, which shows gross public debt as a percentage of gross domestic product. It's an indicator of how much the Japanese government owes relative to the country's economic output, or GDP. According to the latest data for the year 2022, Japan's public debt to GDP is over 261%, a figure that is so much higher than any other nation out there. It is much higher than economies which are struggling like Greece, which only has a debt to GDP ratio of 178%, or even Venezuela, which has 157%. There is no country today that has a debt as big as Japan when compared to their GDP. In actual figures, the total debt of Japan is over 1,286,000,000,000 Japanese yen, or about $8.6 trillion in 2023. This figure is undeniably a massive amount. Such a considerable figure has led many people to believe that Japan's time as an economic leader is over. It is even possible to say that if an economic crisis were to occur again, like those of the COVID-19 pandemic or the 2008 Great Financial Crisis, it would lead to Japan's debt ballooning to an unprecedented level. But the question is it really a problem? That's what a lot of people see. While there are arguments saying that it's not a big problem, and others saying that it is, what is clear is that everyone wants to know whether the Japanese government can lower the debt. But the question is how? Well, to understand all these, let's first talk about why it's not really a problem. Japan's national debt has risen at a fast pace over the past few decades. Here's data to show how fast it grew from the International Monetary Fund. You can see that in 1990, the debt to GDP of Japan was just 63%. But it grew fast to over 135% by 2000, then another rise to over 205% by 2010, and to where it is today. But even though it has risen fast and every single year, Japan's economy didn't really collapse. The only problem is that it's stagnant, not growing at all. Here's the GDP of Japan from the World Bank, which clearly shows that Japan's economy has been stuck at $4 to $5 trillion. But if you use the GDP with constant 2015 US dollars, you get this. It does show growth, although a little subtle. The reason why we use constant 2015 US dollars to measure GDP is to adjust for inflation. By using a fixed base year like 2015, we eliminate the effects of price changes over time, allowing us to observe real growth in economic output. This means that any changes we see in Japan's GDP in constant dollars reflect actual growth in production and services, not just changes in price levels. Now, let's talk about why it's not really a big problem. This is not to say that it isn't a problem. It is a problem that hinders economic growth. But the likelihood of Japan's economy to collapse is less than most other indebted nations. The reason is very simple, and it's in the nature of Japan's debt. A country's national debt can be viewed from two ways: domestic and foreign. Domestic debt is the money a country borrows from its own people. In Japan, this can be held by Japanese citizens and institutions. Here's a graph with data collected from the Bank of Japan for December 2023. It shows the breakdown of JGB and T-bill holders. JGB is known as Japanese government bonds, which are debt instruments issued by the Japanese government to fund its spending. T-bills, on the other hand, are short-term debt instruments issued by the government to manage its immediate cash flow needs. These two are representatives of Japan's debt structure, and as the graph depicts, you can already tell what it looks like. Over 47.9% of these are held by the Bank of Japan, BOJ. The BOJ is Japan's central bank, and the reason why they hold so much of Japan's debt is because the Bank of Japan has been buying up government bonds for years to keep the economy stable and prevent interest rates from rising. This approach, called quantitative easing, allows the BOJ to create more money by purchasing large amounts of Japanese government bonds. By holding nearly half of the country's debt, the BOJ is able to keep interest rates very low, which makes it cheaper for the government to borrow money. The third largest holder of these are banks, holding 13.1%, and these banks can be anything from major commercial banks to regional banks and other financial institutions within Japan. These banks invest in Japanese government bonds because they are considered low risk and stable. By holding JGBs, banks have a reliable asset that provides steady, if low, returns. Then, as you can also see, the holders of debt other than domestic ones are foreign, and they hold only a small amount of just 13.5%. The reason why this is so important is because if Japan borrows money from its own people, domestically, they can manage their debt more easily rather than if it were to be borrowed from foreign entities. This is a very important reason why Japan's debt is so manageable, and the economy hasn't collapsed yet. If, for example, the opposite were true, if Japan's debt structure were composed of foreign debts, then the economy would most likely be in a turmoil. That's because, if their debts were borrowed from foreign creditors, then it would most likely be denominated in a foreign currency, like the US dollar. The main problem with borrowing in a foreign currency is that Japan can't print the US dollar. That means if they run out of these foreign currencies or US dollars, which is something they can't print, then they'll fall into a big problem. But as the Japanese economy is heavily reliant on domestic debt, they can instead print the Japanese yen through the Bank of Japan to manage their debt. By having debt mostly in yen, Japan can effectively control its debt repayment process without depending on foreign currencies. If the government needs to service its debt or stimulate the economy, it can rely on the Bank of Japan to issue more yen, a flexibility not possible with foreign debt. That is basically a major reason why Japan isn't in turmoil. Another important reason you need to understand is the concept called fiscal policies. This is a major reason as to what drove Japan's debt to rise to where it is today. Fiscal policies are basically a government's budget. It is their spending and expenditures. Here's an overview of what that looks like for 2024. This is data from the Ministry of Japan, MOF. As you can see in this graph right here, we have the general account total expenditure. As you can see, the expenditures are spent on various things like social security, national defense, public work projects, and most importantly, the servicing of national debt. National debt service takes up a massive 24% of the general account total expenditure for that year. Although it's big, it's not really concerning given the fact that, as we mentioned earlier, Japan can just print money, or fundamentally speaking, borrow it at a very low interest rate from the Bank of Japan. And like their expenditures, Japan also has revenues. They have to finance their expenditure after all. This is the graph, as you can see here. A huge portion of it comes from tax and stamp revenues, and the second largest comes from bonds, which are again Japan's debt. They expect that over 31.5% of the entire revenue to finance their expenditure will come from debt. This is what led to Japan's debt to rise, as they continued to spend more than they earned. Here's a table published by the Ministry of Finance of Japan with OECD data of various countries in fiscal balance as a percentage of their GDP. As you can see, Japan has consistently had one of the highest budget deficits among developed countries, especially since 2010. This means that Japan's government has been spending significantly more than it collects in taxes and other revenues, leading to an increase in debt. Unlike countries such as Germany or Canada, which have managed to maintain or return to smaller deficits, Japan's fiscal balance has remained heavily in the negative territory. But despite that, and as we mentioned throughout the video, the reason why Japan can finance these large deficits is because of domestic debt. Now that we have a clear understanding of Japan's debt and why the country isn't really collapsing, let's now talk about the Japanese plans and potential plans that can help reduce Japan's debt. Indeed, even though it's not really a big problem, it still needs to go down because high debt levels pose long-term risks and could limit Japan's ability to respond to future economic crises. The first way Japan is trying to reduce its debt is through fiscal consolidation and expenditure control. Yes, Japan has been spending more than it earned, but that's also because the country has too many problems. Here's a dataset that shows you how Japan's fiscal balance has been going down prior to the COVID-19 pandemic. You can see that from 2017 to 2019. The government budget deficit had actually shrunken compared to previous years. This is because the government had been trying to reduce expenditures and increase revenues. It was only because of the COVID-19 pandemic that led to a huge rise in deficit. Once again. The same story occurred in the 2008 global financial crisis. The second is through tax increases. Over the past few years, Japan has raised taxes in certain parts of the economy. You can see a graph of this through tax revenues as a share of GDP. As you can see, tax revenues have risen fast. Although back in late 1980s, it was nearly as high as it was today. But since then, it hasn't gone up this much, until lately. Among the reasons why is because of the continued hikes in certain taxes. Recently, they have even been discussing raising taxes on some certain instruments, like investment income. Thirdly, the most important way for them to fix the debt problem is to continue where it is today. They need to keep long-term interest rates near zero, as it helps minimize the government's borrowing costs on new debt issuance, making it more sustainable even with high debt levels. Being able to borrow at 0 or near 0% is invaluable for Japan's debt management because it allows the government to fund essential public services and investments without an unsustainable rise in debt servicing costs. One can say it's almost free money as it is without any interest. But anyway, do let us know what you think. Thanks for watching.